US-China trade wars, the government shutdown continues, Mario Draghi keeps interest rates, and lots more stimulus going to the EU. But of course, things are going just great. However, none of this started now. It started a while ago. We've been getting the warnings of a major global crisis. And I'm going to show you specifically with China how that all fits in coming up. I'm Lynette Zang, and welcome to ITM Trading. And today we know this. On December 4th, the U.S. yield curve inverted, where the lower yields on shorter-term bonds went above the longer-term bonds. That started on December 4th, and it's still true today. Now, they want to tell you that it doesn't matter, and maybe it doesn't matter, but maybe it does, since it's one of the key predictors to a looming recession. But this recession is way different than the past recessions, because you say, recession, not so bad. Look, we've had lots of recessions before, and we've always overcome them. But we had balance sheet room, and we had interest rate room in the last recessions. This is much bigger, or what's coming before us, what all the markets have been warning about, is much bigger. But you know, I wanted to really hammer this home for you in the US because we're hearing how great things are. But I want you to remember that in May of 2017, China's yield curve inverted. Did nothing happen between then and when we went into a trade war? Or are the trade wars an excuse to cover up what's really happening globally? Because the truth of the matter is this letter from Tim Cook and Apple, and you know, we've got ETFs, we've talked about all of this. But in their January letter, in Tim Cook's January letter to their shareholders, what did he point out? They did not foresee the magnitude of economic deceleration that we've really been witnessing for quite some time. Over 100% of their year-over-year worldwide revenue declines, China. And as the climate of mounting uncertainty weighed on financial markets, effects appear to reach consumers as well. Well, what do we know about the Chinese economy? It's based on consumerism. First, when their currency pegged or tied itself to the US dollar, and Meg, make sure that you write this down. I'm going to do a one-on-one on pegging, and when I get that posted, you absolutely, positively, 100% need to make sure that you view that video. But when currencies peg or unite together, that means that both economies have to behave that way. So if one economy takes on a whole bunch more debt, so does the other one. No pegs last. And the current peg system really started breaking down in, let's see, what year was that? 2015, as right before actually the ECB announced their version of QE to infinity. And it started with the Swiss surprise when the Swiss currency depegged from the euro. But then in August, that was January, in August, we had the Chinese surprise where they began to partially depeg and shift that pegging from the US dollar. And what has China's response to all of this been? Well, pretty much the same response of all central bankers: lower interest rates, encourage and increase debt. But it comes to a point where it may be more like pushing on a string. And I'm going to show you what I'm talking about with all of this. But what has been the Chinese solution? Well, we know that they allowed their citizens to buy gold, pretty easy to confiscate in that kind of environment where you have a dictatorship, which is basically what China is these days. And they've been growing their gold reserves like crazy. In fact, in 2015, they had a massive, new computer, I'm still getting used to it, sorry. But they had a nice little run up in their amount of reserves. And that's just what's been reported. So amongst all of the decline that they're experiencing and against their economy that's based upon global consumerism, and they've been trying to build their local consumerism, they're hedging their bet with, what do you think? Gold. Duh. Let's see why. Let's go a little bit deeper into this, because this is the Shenzhen index, and it goes back to, this was on the 17th, but it goes all the way back to May 17 when their yield curve inverted. So even though the market went up a little bit, so if the U.S. market goes up a little bit, I already showed you last week that it was in a it's in a trading range and showed you what that range was. That doesn't mean the worst is not still ahead of us. Because in a surprise announcement, China, exports fell 4.4% year over year. That is indicating falling global demand. China's been the manufacturer to the world. Shocker. But even worse is the falling local demand, as witnessed by the imports falling 7.6% year over year. That is a huge decline. It goes back to Tim Cook's letter, warned us about it on January 2nd. But it doesn't just stay in China. It goes globally because we know there's really only 41 systemically important financial institutions on the planet. And they're all completely connected. So the real problem is the contagion, and not the contagion just in Asia, but it's the global connection. When the Asian currency crisis happened back in the late 90s, they were able to contain that a little bit more. But since then, that's when the derivative markets exploded. That's when everything has been really a lot more leveraged. So what do you think is likely to happen this time? Because as China's been trying to defend its markets and defend its currencies, of course, we see how much debt they're taking on. We can see that they are getting rid of their foreign exchange holdings, except for gold, which they have increased. But let me tell you what, when that currency breaks, here's what that looks like. What warning did you have over here? What warning? You had no warning. Of course you have no warning. It's a surprise. So when that surprise occurs, what position do you really want to be in? Because they are struggling. They are all of these central banks. Globally, they are struggling to keep things afloat. And it's all about that consumerism, whether it's global or it's local. So, hey, things are great in the U.S. The consumer's spending, spending, spending. But for how long? And how much more debt can they take on? And we're looking at, well, Wilbur Ross said this morning, which I thought was pretty interesting, for those furloughed government workers that haven't had a paycheck now in over a month, just get a loan. What's the problem? I don't understand what the problem is. No, Wilbur, you wouldn't understand what the problem is. You're a billionaire. You've always been a billionaire. I'm pretty sure you have never had to live paycheck to paycheck. And what happens when you're that tight when the paycheck goes away? But maybe some of my viewers have experienced that in the past. I hope none of you are experiencing it right now. But if you do, you can be more empathetic with that. So all of this stimulus, because what tools do they have? They have debt and they have interest rates. And what happened in 2008 when they went to all those extraordinary policies? They took those two tools and wow, they hyperinflated the debt and they smashed the interest rates to negative. The EU can't even come out of it negative interest rates. No, things are not hunky-dory. All of this debt is now coming due. And every single bit of it is due before the end of 2021. Because that's when the IBORs go away. So do you see why they need a crisis now? Though if you listen to mainstream media, well, yes, that's not looking good, but we don't see a recession. No, no, that's not good, but we don't see a recession. At least not yet. The consumer's spending. The consumer's taking on so much debt. All debts will get paid by the end of 2021. Unless, of course, if the reset happens before that. Then, of course, they'll get paid off with dollars that have no values, or euros or yen or any of the other ones. So while the people on mainstream media tell you, yeah, well, maybe a recession in 2020, I don't think that they're powerful enough to hold that off. And they're simply looking at the historic difference between or time frame from when a yield curve inverts to when everybody else sees it. But it happens way before that the economy is in a lot of pain. And so all of this injection, all of the things that the Chinese government has done, and more debt, they don't have any more tools. Here, borrow, we'll make all this credit available. Well, they have to spend that credit, don't they? The corporations and the individuals have to turn that credit into debt and then go out and spend it. That's not really happening. The corporations are taking on lots more debt because they know that they're really bankrupt. They know that they're just zombies. But they're not spending it to stimulate the economy. They're holding it because of what they see coming in the future that does not look good. And in all of that backdrop, what actually performed last year? Well, interestingly enough, in this survey that was done by gold.org, here's spot right there. This is long, which means I own it, I hold it, I own it. Physical gold outside of the system was the best performer in 2018. Shocker. Flight to safety. So I'm going to let you know that the event that we have on February 9th, the registration ends on Monday, February 4th. So that's it for the registration. If this is something that you're thinking about doing, then I'd get it done, because we have that restriction, but we only have a few seats left as well. And we are not going to expand it because we want lots of hands-on and one-on-one time. So if you are an accredited investor, this is definitely the event for you. And I can tell you, because I've been buried in it right now, this is the best work I've ever done. My mother always said, if it's true, you can say it. And I'm going to tell you, I am getting goosebumps. I love the work that I'm doing for this event. I am 100% certain, I mean, I guess I can't guarantee it, but I'm 100% certain that anybody that comes to this event will walk away from it a whole lot better off and understanding a whole lot more and having the kind of plan that they can execute where no one can pull the wool over your eyes. That's what I'm going to give you in this event. So I hope to see you there, because I'm looking forward to it. I'm really excited about it. I am. So if you have any questions about it, you can go to our website, itmtradingevents.com. You can talk to our strategy specialists. They all understand the strategy. They are all here to help you. We are all here to be of service. And keep in mind, Shields are made of metal, not paper or promises. And until next week, please be safe. Bye-bye.